Podcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I think we're going to get started right on time here. Today, we're going to be talking about the current state of our market indicators, most of which are option-based, but not all of which are. And this is a pretty interesting time in the market, although I guess any time is a pretty interesting time in the market. But we're certainly having some, very interesting movements here recently. So let's get started. Just a little background on our company. We started out 31 years ago as a derivatives research firm with newsletters, selling data, analysis, things like that. Then after the 2008 financial crisis, we had done pretty well with our recommendations. So at the request of some clients, we moved into the money management area. So we manage both futures accounts and SPY related accounts on the stock side. But we just do one particular option strategy for the most part. And then we also do a certain amount of option education, things like this webinar, and we also have a mentoring division. I'll come back to this later, but we will be sending you a PDF of the webinar. Actually, I believe it's you can download it yourself at this URL at the bottom of the page here, optionstrategist.com/MCM web. And that will also get you into a page which has these particular offers on it. This is our home study course, 14 separate courses, or, separate webinars, or 1 month of each of our top newsletters. I'll talk more about that later. So the main indicators that we look at for the market are first and foremost the chart of the S&P 500, because that's the real price of the market. So if your indicators are all saying buy and the market's going down, then the market is right. It's your indicators that are wrong. So we like to make sure that we're in tune with the market itself. Then we'll look at equity only put call ratios. We'll look at market breadth, where we have a option oriented twist to that. And then we'll look at VIX, and we'll talk about VIX and the volatility indices and the futures and other derivatives based around VIX. So there's a very important rule, and it's in effect right now. Oversold does not mean buy. So the market's oversold. It was oversold a week ago, and then it got creamed again on Tuesday. So oversold markets can't continue to fall for quite some time. There's a companion statement, of course, and that's overbought does not mean sell. That's happened a little bit earlier this year as well, although it happened more frequently back when there was a bull market. Right now we're in a bear market. So we'll try to apply those rules, and I'll show you where they appear. So this is a 2-year chart of the S&P 500, and the one thing I want you to really take away from this chart is just one line on this chart, and that's, of course, the bear market trend line at the top of the page here, right here. So you can see that the market peaked in January, had a big oversold rally in late March, and then another big oversold rally just a month ago. And all three of them died at about that trend line. And the last one also ran right into the 200-day moving average at the same time. That was more than it could handle. So now we've pulled back. And, you can see we bounced last week off of 3,900. Yesterday, we came all the way back to 3,900. Today, we actually traded down not quite to 3,900, 3,912 was the low today, but in that general area. So that's building as a support level. And I think it probably will be broken, but, we follow what the market says. We don't expect the market to do what we think it will. Just to show you how the declines on this chart stack up, back in March of 2020, when was the pandemic sell-off, the market dropped 35% in a month. Since then, we just had a minor correction of 10% in September of that year, and then September of last year, the only correction was an even smaller one at 6%. But this year, of course, things have changed, and at one point we were down 24%. I don't believe in saying certain percentage is a bear market or a bull market. I would rather look at the trend of the market and say that's what's dictating. So right now we're getting a series of lower highs and lower lows, and that's a downtrend. The lows are connected in a more even a steeper trend line along the bottom here, but it's the upper trend line that is the one that's really important. This one has also been met a few times along the way, though. Most recently, they're back in June. So as long as the market is in that trend, that's a downtrend, that's a bear market. So here's a little bit closer look. This is just a 1-year chart. And I've marked the oversold rallies on here. Bear markets are replete with oversold rallies, and that's the number of S&P points in each rally. Some of them are pretty big. It was a 500-point rally there in March, and now that we just had a 550-point rally from mid-June to mid-August. Now we've fallen back. Um, there's an old saying that nobody makes money in a bear market because the bulls refuse to sell, so they just hold it all the way down and get creamed, and the shorts keep getting stopped out by these big rallies, and so it's very difficult to make money in a bear market. I disagree with that. I mean, if you're going to try to hold, I suppose maybe that would be the case. But these rallies, even so, even if you're trading systems like we do, still make things somewhat difficult. So if we were to break that 3,800 level, 3,900 level, then we would come to there's some support back in here at the 3,800 level, and of course then down at the lows of 3673. If we break that, then we've got some severe problems on our hands, and we'll talk about the macro picture later on. So just to kind of summarize that, we've been in a downtrend since early January. We've been holding a core position since probably core bearish position since about February. There is support right now at 3,900, and then I would expect the bulls to try to materialize support at 3,800. On the upside, that failure at the 200-day moving average, as well as at the trend line at 4,300, was pretty clear evidence that there's still sellers out there if the market rallies too far. But as we saw, as we have seen, oversold rallies are very plentiful in bear markets. So we are maintaining this core bearish position. If you've seen our newsletters, we talk about that all the time. But we will trade, signals around that. So if we get buy signals, we will trade those as they occur. All of our systems have stops, and so as we discuss these today, you'll see that we don't just randomly buy the market and then hold it. I mean, the worst thing is to say you're holding a core bearish position and then go long and refuse to, trade out of your longs. So there's one more thing we do with the S&P chart is that we draw modified Bollinger Bands on it. Now, why are they modified? Well, they're modified because we use the Black-Scholes definition of volatility, which is slightly different than the volatility that John Bollinger used when he invented Bollinger Bands. But since we're an option-oriented firm and all of our volatilities, our realized volatilities, have to line up with the implied volatilities, and the implied volatilities, if you calculate them with the Black-Scholes model, use the Black-Scholes definition of volatility. So for those to all line up, we use that definition. So we draw what we call modified Bollinger Bands on there, and we draw the 3 and 4 standard deviation bands. And then if the market moves outside those bands, it sets up a signal when it comes back inside. So we've had some great trades from this in the past. We've been using the system for a number of years. If you look at our option strategist newsletter, you'll see that we've made $17,000 or something with this system, just basically trading 1 or 2 lots over the years. But there were a lot of negative signals, whipsaws, false signals, what have you. So we put another filter on the trades, and that we call the McMillan Volatility Band, or MVB. So here's how it looks right now. So this chart shows the modified Bollinger Bands on it. And so this lower band here is -4 sigma, and the one just inside it is -3 sigma. So you can see here, for example, that this is the -4 sigma line. The market moved below that, well below that, so that sets up a buy signal. And the buy signal occurs when it moves back inside the 3 sigma. So right there was the buy signal. Now we hold those until the other side of the band is reached, and it was eventually reached here. That trade, if you're just using S&P prices, is a winner. If you're actually holding options and losing time value, is probably a loser. In fact, it was a loser. But we did have then a very nice buy signal here in late June, and now we've had a sell signal here in mid-August, and that culminated right here, and now we have a new buy signal. So this system is giving us a buy signal a few days ago, and we will be holding that until either the upper band is reached, so until it rises to this upper band. And of course, that's a moving target. It moves with not only with changes in volatility, but with changes in the S&P price. Or we would be stopped out if it falls back below the -4 standard deviation band, which is plunging right now. So just to repeat, we had a new buy signal as of last Friday, and so we're holding that right now. We're holding that with a SPY bull spread. We do calculate the modified Bollinger Bands on everything, every stock, every index, every ETF, every futures contract. So if you're interested in them and those setups, we have a service that we will email you every day where the setups are occurring in various markets, and you can trade those if you want. We don't have a specific service based on recommendations on these, but you can, it would be for those of you who are more do-it-yourselfers and want to trade your own systems or follow your own stocks or what have you with the McMillan volatility band signals. All right, so so much for the S&P chart. Let's move on to the next topic, which is the equity only put call ratio. So we use that's all stock options that trade. So we use all stock options that trade, the ratio puts in calls, and as you'll see, the dollar ratio as well, to predict the broad market. And I'll briefly explain why in a minute. But the theory of put call ratios was invented by Marty Zweig back in the 1950s when he was getting option volume out of the ads that the put and call dealers ran in Barron's every Sunday, and he would add up the number of calls traded, the number of puts traded. And he started to realize that when there was heavy put buying, pretty soon the market went up. And when there was heavy call buying, pretty soon the market went down. So this was a contrary indicator. So we have our own definitions of what too much put buying is and too much call buying. I'll show you that in a second. But we do use this indicator quite a bit, and we use it on individual stocks, futures, and indices, as well as, of course, on the broad market. So simplistically, let's say we're talking about IBM. At the end of the day, in IBM, we sum up the volume of all the puts that traded. Separately, we sum up the volume of all the calls that trade, divide the two, and that's the put-call ratio. So since puts are in the numerator of the fraction, heavy put buying makes the ratio go higher. But when you're really likely to have heavy put buying, well, that's probably when the stock is going down. That's when people buy puts more aggressively. So the ratio and the stock price move in opposite directions. We can come to the same conclusion if we look at call buying. Call buying is in the denominator of the fraction. If you increase the denominator of a fraction, the fraction drops. But when would call buying be increasing? Well, that would be when typically when the underlying is moving higher, the stock or SPX, what have you. I keep a moving average on this. I keep a 21-day moving average. Just in case there's something to Fibonacci, but you do need something to smooth it out a little bit. So in theory, this is what we like to see, or this is what we do see most of the time. If the stock is dropping in price, the put-call ratio is rising, with people are buying puts. Eventually, the put-call ratio forms a local maximum. And a local maximum in the put-call ratio is a buy signal for the stock. Then the stock starts moving higher. Moved over here to the left. As the stock is moving higher, traders are buying calls, forcing the put-call ratio to go lower. Eventually, we get a local minimum on the put-call ratio chart, and that is a sell signal for the stock. So we publish over 1,600 put-call ratio charts on our website every day. And what you would want to do if you're looking at these on your own is to look for this inverse symmetry. If you don't have the inverse symmetry, then something else is going on. Perhaps takeover rumors, some sort of arbitrage situation, or something that's dominating the action apart from speculation. Pure speculation, though, should produce this kind of a chart. So this is not a current chart, but on top is the S&P 500. And on the bottom is the equity-only put-call ratio. That is all stock options that trade on all the option exchanges in the U.S. I think there's 8 or 9 of them now. And you can see the inverse symmetry that exists here most of the time. It's highlighted in red and blue. And so that is why we use the equity-only put-call ratio to predict the broad market, because this inverse or contrary symmetry does exist using that ratio. So here's the current equity only standard chart. And by standard, I mean we're just looking at stock option puts and calls, no volume. We're looking at the number of calls traded, the number of puts traded, but no dollar volume. So you can see, for example, the most recent thing we have on the chart is a local minimum. Remember, a local minimum is a sell signal. So that was a sell signal for the market right here. It's sort of interesting to note that that rally we had 2 weeks ago was, seemingly substantial rally, really didn't appear as anything on the put-call ratio chart. In other words, traders were buying puts right through that rally. So this is still moving higher. Eventually, it will come up here, roll over, and produce a buy signal. I don't know where. We have a computer analysis program that looks at these charts. It's sort of like a chess playing tree thing, like what a chess tree is. And so it helps us identify turns in the ratio very quickly, so that when it turns like this, we don't have to wait, let's say, 10 days for it to get all the way over to here before we decide that that was indeed a local minimum. It can help us identify the local minimum right away. Currently, this ratio, these computer analysis programs are saying that these ratios are going to move higher. So just to note here, back in last November, the ratio was very low. It was all the way down here near 40, meaning 40 on average over all stock options that trade. 40 puts, or in this case, let's call it 38. 38 puts were traded for every 100 calls. That's a low number. In fact, this is the lowest number since in 20 years, 22 years, and represented extreme optimism. There's not many puts were trading, a lot of calls were trading. Everybody's very optimistic on the market. And of course, as we know, it did make one little attempt to go higher, but that was it, and then started into this bear market. So as computers became more prominent, we could calculate another put-call ratio, and that's what's called the weighted put-call ratio, or the dollar weighted put-call ratio. And in this case, we take into account not only the option volume, but the price of the option. So for each option, and what we do this at the end of the day, we take the option's closing price and multiply it by the option volume that traded that day to come up with the dollar volume estimate for that option. Now, obviously, you could do this tick by tick. That was a very expensive data set when we tried it, and wasn't really giving us any better results than we get by using this. So this is the way we do it. So we make that little calculation there, let's say for every option on IBM at the end of the day. Then we sum those all up for the puts, and separately we sum up the calls. And so now what we're looking at is the ratio of the dollar volume of the puts to the dollar volume of the calls. And this, again, will give us a put-call ratio that we can look at and treat in the same way: local maximum, local minimum, all that sort of thing. But now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. Ironically, the signals occur more or less at the same points as with the standard chart, but they occur at much more extremes. So again, here, our most recent signal was this local minimum right here. Again, a local minimum is a sell signal. So that's a sell signal, and the market has been dropping. Also, as I noted with the other one, that little rally we had, a couple of weeks ago, gave us a little wiggle on this chart, but that computer analysis program I was talking about looked at that wiggle and said, don't worry about it, this chart's moving higher, and it has. Again, the extreme optimism of last fall was evident in November when this ratio dropped to the lowest it had been in 18 years. So those are significant things if you get down that low. We're now, or at least in May there, we got to the highest level we've been at since the pandemic crash in 2020. And that's a pretty high level. So that was a lot of bearishness being expressed there. So it's ironic that in 6 months we went from an 18-year high in optimism to basically, an almost all-time low or high in pessimism, low in optimism. That's how fast sentiment can change. So just to summarize, these are pretty strong signals and they don't occur all that often. As I said, these last sell signals have been in place since mid-August. They didn't get swayed by that rally that occurred. And as long as they're continuing to rise, they're going to be on sell signals. So this important indicator is not rolled over yet. So what do we trade when we get these signals? First of all, when we're getting signals on the bond market, we trade SPY options. You're free to trade E-mini futures options if you want to, or SPX options if you want to, but they're all relatively the same thing. But the important thing is, I think you should try to concentrate on buying an in-the-money option with a delta of 70 or higher. The reason for that is I'm pretty confident these indicators can predict where S&P is going. So I don't want to be right about where S&P is going and then have bought an option that loses money, even though I was right to say I bought an option too far out of the money with not enough time remaining. So in this case, a delta of 70 is going to be an in-the-money option. And even if I go out a little bit longer, let's say 6 months or so, an at-the-money option is still going to have a delta of 55. So it's going to participate on the upside is what I'm saying. If I'm right on the underlying, I'm going to make some money by buying this type of option. Now, if you watch TV, you see these guys spread all the time. And, we have been spreading a lot in our SPY positions recently too. But basically, if implied volatility is right in line with where it always has been, there's no reason to spread. You will only spread if implied volatility is higher than normal. So we have free volatility data that we put up on our website every Saturday, and you can get the implied and historic volatilities of every single thing that trades options, every futures contract, every month of every futures contract, all the stocks, all the indices, etc., ETFs. So when you do spread, you cut off your profit potential. So by spread, I mean you're going to buy a lower strike call and sell a higher strike call, let's say. So your downside is limited, but your downside is limited when you buy a call anyways. But here now, your upside is limited. So the only time that makes sense, and you can prove this statistically, we don't really have time to do it now, but the only time it really makes sense to use a bull spread is when the options are expensive. Now with VIX here in the mid 20s for most of this year, I consider that expensive. I mean, VIX hasn't gotten the crazy expensive that it did in 2020, but that's still pretty expensive. So an at-the-money option is a pretty, rich option, and so we have been spreading in SPY. But if we consider, a lot of times proponent of the spread strategy say, well, you're risking less. You're not risking less. You're risking 100% whether you buy a bull spread or a call. Both cases, you're risking everything you put up. Now, dollar-wise, yes, it's a few dollars less. So is it worth it to, save? Here's the graph of owning a call, the red line, and here's the graph of the bear spread. So is it worth it to save that much money and give up everything above that price right there? I would say no. The way that you really make good money is you hit a few monster trades and you manage your money on all the rest of the trades and you come out way ahead. So Don't spread unless the options are really expensive. And even if you do, use two things you need to do to mitigate the fact that the market could go through your spread. In other words, rise all the way up to the point where the spread caps off. One, widen the difference in the two strikes. And number two, roll the short strike if it gets hit. So, for example, right now in SPY, if we're doing a call spread, I'll have the strikes 13 to 15 points apart. And if we're doing a put spread, because the puts are more expensive and there's a skew in the puts in S&P or in SPY, I'll have the strikes 25 to 40 points apart. Now, what do I mean by rolled short strike is hit? Well, suppose you start out with SPY at 397, you buy an at the money call. And these days, an at the money call is going to be pretty expensive. I would say it's going to cost you about 13 bucks or something. And then in this case, we're going to short a call 15 points out of the money. We might say get 4 for that, maybe 5, something like that. Anyways, suppose the market then rises and hits this higher strike. It gets up to 412. All right, so take your profit on the first spread because there isn't it won't have widened out to 15 points, the difference in the strikes, but it will have widened out some. And from then on upwards, profits are limited. So take your profit on that spread and buy a new spread set up here. You can keep doing this continuously. And then eventually you'll have pocketed enough money that even if it falls back, you won't really care because you'll have a bunch of credits in your pocket every time you reach the higher strike. So these two things, widening the strike and rolling the position up. And of course, if you're long a put bear spread, you would roll it down. It's when the market gets to your short strike that you need to make the roll. Anyway, let's look at some individual put call charts. These aren't quite as good as they usually are. There hasn't just been a lot of activity in these recently, but this is one AIZ. Now, I want to point out one thing that we do with these individual stocks and futures put call ratio charts is we only use the extreme signals. So like this little local maximum right here, and this little local minimum right here, we don't trade those because they're just too noisy in terms of individual stocks. What we wait for is it to get up into the extreme area. So there was a buy signal here back last February. You can see that worked out pretty good. And now there's just been another buy signal here a week or so ago. And the stock is, well, struggling to get going, but, they don't happen immediately. By the way, you can see this is a pretty good sell signal on the stock there too. And this one was not as good, but it was also a somewhat profitable sell signal. Tyson Foods. Now, this one, I don't know exactly what's going on here, but there was huge put buying. It drove the put call ratio all the way up towards 350. This is a weighted ratio. So that means that $350 are being spent on puts for every $100 being spent on calls. That's a lot. I mean, that's just crazy pessimism. And you can see the stock has been going down since April, so that creates pessimism, of course. So we're going to try to see if this can break this downtrend line. If it can rise up above this downtrend line, then we'll act on the signal. So we don't always act on every signal just randomly, just automatically. We also look at the chart. This is Pfizer. Now, Pfizer looked like it might be trying to put in a little local maximum there, which would have been a buy signal, but no, it went higher. So we don't know where the buy signal is going to come, but we do see that this is the highest the put call ratio has been in the last year, and in reality, it's the highest it's been since March of 2020. So it's around, you can see here, it's around 160. That's $160 being spent on puts for every $100 being spent on calls. But this is a big company. That's a lot of pessimism for a pretty well-renowned company. And you can see the stock is really, it went down the first couple of months of this year, and then it really hasn't gone down since then. So eventually, though, this is going to roll over here pretty soon, I would suspect, and give us a buy signal. So it's worth watching. This is gold. This is the ETF on gold, GLD. And so these are not gold futures options that trade on the COMEX. These are GLD options that trade on like the CBOE and other U.S. exchanges. Again, extreme pessimism here. The ratio is high and rising. Now, the signals haven't been all that great in this, and I do normally like to see that previous signals have been strong. So I'm not all that excited about this, but it's so high in comparison to where it's been before that you can see everybody's bearish on gold. And so that's not everybody, of course, or it would be infinite, but a lot of people are bearish on gold. So we're looking to go the other way. And when that ratio rolls over, there will be a buy signal for GLD. Just throw this in here, ARC. People are always interested in what's going on in ARC. These signals have been so-so in ARC. Most recent one here is a buy signal. You can see they got the local maximum, and it's near these other highs here. I'd really want to see maybe this thing at least maybe break out over that level before you got too excited about it. The only really good signal on this chart is this sell signal that came back last November, where we got a local minimum for extreme optimism that was right in concert with the optimism we saw in the equity only chart. We can also do this with futures options. This is corn. These are the futures options that trade on the Chicago Board of Trade. And again, local maximum, local minimum. This is not a recent signal, so we can't really use it, but we did recommend this in the Option Strategist newsletter. And you can see there was a local maximum here back in July. And since then, the market's moved up nicely. Now, I will point out, as long as this ratio continues to decline, we'll hold our position. We might roll it up. Like I said, you can always roll up, take some credits out of a long call position. But typically, and even when we first get in the position, if we have fallen to a new low or something, the stock price, the futures price, we don't care. As long as the put-call ratio is still declining, that's still the buy signal. That's our indicator that we're following in this particular case. So we're still long corn options. All right, let's move on to the next topic, which is market breadth. So breadth is strictly advances minus declines. You can keep it on a bunch of different things, but typically people look at the New York Stock Exchange data, advances minus declines, as the most common measure of breadth of the market. So that's one thing you can do with it. You just keep adding that up every day and keep a cumulative running total. The other thing you can do is keep an oscillator, which is what we do. And our definition of our oscillator is today's oscillator value is 90% of yesterday's oscillator value plus 10% of the difference between today's advances and declines. So we do this with New York Stock Exchange data. And if you want to do that at home, all you would need is the starting point, which would be yesterday's value. So if you want to email me for that, I can give it to you. But we also noticed that that didn't quite work all the time because on the New York Stock Exchange, there are things that are not stocks. There are a lot of interest rate related vehicles, and when interest rates get a little crazy like they are now, that can get a bit distorted. So we actually first noticed this back about the turn of the century, and we went to also used a stocks only calculation. And now the New York Stock Exchange puts out what they call an operating company only index, but I didn't like that well, and I figured, well, we've got a great set of stocks that we use every day. That's all stocks on which there are listed options trading. So that's our stocks only data set. You can't really keep that one at home, although we do publish the data every day in our daily newsletters and weekly in the Option Strategist. So here's the oscillator going back 9 years to 2013. And by our definition, the oscillator is oversold if it gets below minus 400, and it's overbought if it gets above plus 200. And there was some back testing a long time ago to determine that. Well, you can see that, the market went up for most of the time between 2013 and 2022. So there weren't too many oversold conditions. There was, of course, this one very bad one, December 2018, right before Christmas. And then, of course, the pandemic selling in October I'm sorry, March of 2020. It's interesting to note that both of those were extremely oversold. People who were trading in this December 2018 market know how bad it was, but most indicators didn't really show that, but this one does. Anyway, this year we came close to that. Even a couple of weeks ago, we came pretty close. Then we rallied recently. The breadth finally turned around, went positive just slightly. So, as I said before, oversold does not mean buy. So this is extremely oversold, but we don't buy till here, till it stops being oversold. So we missed the bottom, but we might get in here and catch the rally. So right here, it went into overbought territory and fell right back out of it again on yesterday. So that gave us a sell signal as of yesterday for the stocks only breadth oscillator. um, these are pretty sensitive indicators. They flip back and forth, and they're better really for short-term trading. But they've been pretty good this year. We do have some whipsaw losses; those can't really be avoided. But it's been a good indicator to have on your side, or at least to be watching so far this year. Now, I'm just going to mention cumulative breadth in passing. I mentioned you could just keep the cumulative total and keep it going. It's really only good for one thing, and that's spotting market tops. And it did spot the last market top. The stock market kept on going the whole second part of 2021 and on into the first part of 2022. But cumulative breadth peaked in June 11th of 2021. So for the last 6 months of last year, the stock market was making new all-time highs. Cumulative breadth was not, and that's a big negative divergence. And that is, it's not a sell signal in and of its own right, but it's a huge warning sign. And you can see that was a pretty good warning sign. So, but right now it's not telling us anything. The next time the market goes back to new all-time highs, then we'll start paying attention to this again. New highs versus new lows. That's another indicator that we look at. I'm showing you actually back here in early April because this is when we first got a sell signal right in here. New lows jumped at very high levels over new highs and maintained it. Since then, we've not had a buy signal from this indicator. In fact, there hasn't even been more than, I believe, 30 or no, 50 new highs in almost 6 weeks. So back then it was sort of eye popping in that you were just a little ways off your all time high, and yet in the stock market, and yet all these stocks were making new lows. What? Yeah, that's how bad the internals of the market was. That's what that negative divergence was all about. But now the market has rallied several times, but these stocks are so far below their highs, they just haven't been able to get back up there. They will again eventually, but right now this has stayed on a sell signal since April. So the next thing I want to discuss is VIX and the various things surrounding VIX. There's a couple of things that are important. First of all, the trend of the VIX chart is quite important. It's more of an intermediate term indicator, but it indicates which, the trend of VIX is opposite to the trend of the stock market. So when VIX is trending higher, the stock market should be trending lower and vice versa. In addition, there are certain times of panic in the market and VIX spikes up and spikes back down again. Those are usually good short-term buy signals. So this last statement is sort of superfluous because this hasn't happened in a while. We haven't had a low VIX really since 2019, I guess. And by a low VIX, I mean something down in the 12 to 14 area. So that statement is, not relevant for a while. But here's the current chart of VIX. So all those Bs are spike peak buy signals. We have a specific system that we trade around those, and the red or orange Bs are successful signals. The blue ones are not. Now, the way we treat it is if we get a signal, say this one right here. The VIX came spiked up, spiked back down. That gave us a buy signal. A couple of days later, it went higher again and came back down, gave us another buy signal. We only trade the first one, and then we hold that for a month. So we didn't really trade that orange one. That's why it's in orange. The In a bull market, you're going to see almost all red Bs on here. In a bear market, the indicator struggles a bit, but it still had a couple of pretty good trades here last summer, and now just recently it's had two failed trades, and it's trying to set up a third new buy signal right now. As you can see, yesterday VIX spiked up to here, and that's a spike by our definition. It has to come back down in this area though before we'll get the buy signal. Now, the other thing I mentioned was the trend of VIX. So the way that we define the trend of VIX is if the VIX and its 20-day moving average are on the same side of the 200-day, that's the trend. So right over here, back last November, remember how optimistic everybody was in the market? They started to turn pessimistic right around the 1st of December. So right there, the 20-day crossed over the 200-day. VIX was already higher. So at that point, the 20-day and VIX were both above the 200-day. That's a trend sell signal. And you can see that, the market went down a lot since then. So that was a pretty good sell signal. Yes, a couple of times the VIX fell back below, and that stops out the sell signal, but doesn't create a buy signal. This 20-day moving average never went back below. Came close again. They never went back below, but now finally here around the 1st of August, it did. And so that switched things to a trend buy signal. And that was in effect for about 3 or 4 weeks. It wasn't that long. And now VIX has jumped back above the 200-day. And so right now we have no signal from the trend. Here's the 20-day right here, slowly rising back up. Here's the 200-day. If the 20 crosses above the 200-day, that will be a new sell signal, just like the one we saw last December. So right now, this indicator is the trend indicator is not giving any signal at all. It had a buy signal that was canceled out, and so we're just watching it, seeing what might happen here. That just sort of summarizes those things. I did want to point out, though, that there have been some discussion of this. You see, VIX is based on SPX options, and SPX options are very expensive options, usually traded by big money. Now, big money isn't necessarily smart money, but a lot of the time it is. And so traders were not selling VIX off like they had in 2019 or 2017 after previous declines in the market when they took VIX all the way back down to 12 or what have you. This time they didn't. It held at 15 during 2021, and now this year has been holding above 20. So these big money players are buying S&P puts. That's what's holding up the price of VIX. And, I wouldn't say they're panicking into them or anything like that, but they are buying them and they're using them for protection. So some people say as long as, VIX is this high, that means the big money is worried. And if big money is worried, you probably should be too. So we can't trade VIX. It's a very complex calculation. You can go on the CBOE website and read about it if you want, but it's a convoluted sort of thing. However, there are futures and options on VIX, and there's a couple of things that we can look at in terms of those futures and options. So I call it the construct of volatility derivatives. So volatility derivatives being VIX futures and options, and the construct meaning, the things we're going to discuss here. So in a bull market, the near-term futures will trade, VIX futures will trade at a low price, then a month out, a little higher, a little higher, a little higher. So the term structure, which is just the name meaning how they all look, if you connect them all with a little line, the term structure slopes upwards in a bull market. And typically, VIX would be at some low level, and they would all be higher than VIX. But in a bear market, just the opposite happens. So this is especially true in 2020. VIX was high. These were all lower than VIX, but still quite high, and they slope downwards like this, the term structure. So that's bearish. Surprisingly, even though we were down 24% at one point this year, and we've been in a bear market really this whole year. The term structure has not sloped downwards, and that some people are saying, when's the other shoe going to drop? When are we going to get this, really bearish turn in the volatility derivatives? I have no idea, but that has not happened yet. But anyway, here's the current prices. I took these last night's prices, and VIX last night closed at 27.27. So, a pretty high level compared to where it's been in much of the time in the past. The front month future is the September future. That's actually going to expire next Wednesday, the 21st of September. That's trading at 26.74. So if we subtract the price of VIX from that, we get negative 53. So that future is trading at a 53-cent discount to VIX. Now you can see all the other futures. This one's a little higher, that's a little higher, barely higher, little higher, same, little higher, little higher. So the term structure still slopes upwards modestly. And these futures out here, they're trading at a premium to VIX. So that whole thing has a slightly positive aspect to it. In other words, the term structure is still sloping upwards, and the futures are still at a premium to VIX for the most part. So while that's not wildly bullish, it's still somewhat bullish. Now, if you don't, the futures, by the way, are available on the CBOE futures website on a delayed basis, so you can always price them there. But the CBOE also publishes other volatility indices. So VIX is a 30-day volatility index. They publish a 9-day, 3-month, a 6-month, and a 1-year. So you can look at their prices. Now here's how they priced last night. The 9-day was quite a bit higher than most of the rest of these, but here this one went up, 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 and if the 9-day gets higher than all the rest of these, that actually identifies a very strong oversold condition in the market. Didn't quite get there, and it toned itself down a little bit today. But the 9-day is still higher than VIX by over $1 at today's close. So, anyways, again, because this term structure slopes mostly upwards, it's modestly bullish. I'm not thrilled about this. I certainly wouldn't say that's a huge buy signal, but it's not a sell signal. The sell signal would come if the front month VIX futures, September, rose above the second month, October, by more than a point. So during March of 2020, they inverted by 18 points, 16 points, so huge numbers. Same thing during the financial crisis of 2008. Remember, I said that we had some great calls back then that had to do with that. And so we made very good money when that happens. It hasn't happened this year. So we're still waiting to see if it might happen. I suspect that if VIX ever does explode, in this bear market, which might happen more towards the end of the bear market, then you would get this inversion. In any case, the bottom line is that this whole construct has not been nearly as negative as we had seen in previous bearish periods in the market. Even a short-term bearish period, like perhaps February of 2018 or something like that, we still had a big reaction from VIX. So far, we haven't. And people are writing articles about it, talking about it, what's going on. I don't think anyone knows for sure. It's a culmination of a lot of things. But basically, I said, this big money is slowly buying, acquiring puts. So they're not really buying, panicking for protection when the market goes down and VIX goes up. They're not really panicking to buy SPX puts. On the other hand, more aggressive traders are seeing that with VIX this high, you can sell an S&P put that's maybe 2 or 3 standard deviations out of the money, still taking a halfway decent price for it. So there are some sellers of those DP out of the money puts. So, demand isn't maybe as high as it normally would be in a bearish market, and supply is greater than it might be in a bearish market. So those things have combined to some extent to hold VIX to lower levels. VIX has not been above 40 this year, which it seems crazy that the market's had some really nasty days, including yesterday, but I believe it was 2 days ago, was S&P was down 50 and VIX were down. Now that you don't see too often. Anyway, here's the summary of our signals. So the only bullish signals that we had right now, you recall we had an MVB buy signal, and then as we just discussed, the construct of volatility derivatives is modestly bullish. Neutral, meaning we have no signal right now from the VIX spike peak, although we will be setting up a buy signal pretty soon. And we don't have a signal from the trend of VIX right now either. The rest of these are bearish. The chart of the S&P 500, that's the most significant one. The equity only put call ratios, we saw they're still rising. New highs versus new lows, new highs just can't get anything going. And the Brent oscillator gave a new sell signal yesterday. So the overall weight of that evidence is bearish. We would trade buy signals as they might occur, on these VIX. We had buy signals from both of these VIX indicators, and they were quickly stopped out. We have pretty tight stops on these. VIX spikes up and back down and get a buy signal, and then VIX spikes on, turns right around and goes higher again. We stop ourselves out. So, decent number of trades, and I'll show you some specifics on that in a minute. But our basic position is, as I said when we began, we're still maintaining a core bearish position because of the trend of SPX, and we will trade those other signals around that bearish position. So you can access the PDF of this webinar both in color and in grayscale if you want to print out and not kill the ink in your printer. But more importantly, we're offering our home study course, which is 14 webinars for $1.99, $199. That's cheap. $1.99 would be crazy. Or 1 month of our 3 top newsletters, Daily Volume Alerts, the Daily Strategist, and the Option Strategist. And you can access those offers at this URL. The special 1 month offer to all 3 of those newsletters can be taken consecutively, so you get a chance to look at each one and understand what it's trying to accomplish, rather than concurrently and just getting blasted with all the information at once. Daily Volume Alerts comes out once a day in the morning. I read that one. The Option Strategist comes out once a week, and I write that one. And then the Daily Strategist comes out 2 times a day, and that's written by one of our other traders. The track records are available for these on our website. Very detailed 31-year track record of the Option Strategist. And for the most part, the strategies in the Daily Strategist are the same ones that are in the Option Strategist, but they're on a daily basis. And the Daily Strategist has quite a bit more data available to you. As I mentioned, we have a data area on our website that's a separate low price subscription. The Daily Volume Alerts, we started that out. We were looking for unusual option volume to predict takeovers. It turns out that used to be a lot more feasible than it is now, because the regulators cracked down on the leaking of inside information, etc. So on TV they try to say that every high volume situation means something. That's not really true, but those are still tradable sometimes. And then of course we have all of our indicators that we just talked about in the last hour that are available on the DVA. So this is how our trades have gone so far with these indicators in 2022. We rarely have more than 3 or 4 positions on at one time, and each one position is $1,500 or less in terms of options purchased. These are all option positions. You can see that the core bearish position, we've actually just been carrying 2 fairly long sequences of that. We have some seasonal trades. Of course, the trend of VIX we mentioned. The VIX spike peak has struggled, as I said. In a bull market, it does great. In a bear market, it struggles. But I can't ignore it because it does occasionally have some great trades. Put call ratio has done very well. The oscillators have done well. And the MVB actually is showing a minus because that one trade early in the year that we had to wait on for it to reach its upside target cost us a lot in time decay. So these are the actual trades using options and not just the theoretical trades that you could have done with the index. Anyway, I think that's a pretty good track record for a newsletter that you can have a trial for $99 of it, and its total cost for the whole year is $1,500, I believe. So we also have a YouTube channel. I invite you to stop by that. We record a market comment every Monday, and just become a subscriber of that. It's like a 5-minute thing. It's not a 30-minute discussion of the market. It's just a short thing. Then we have a couple of other newsletters. One is if you're interested in conservative put writing, which many people are. We have a newsletter for that. And then we have another newer newsletter that deals in special situations. So I'm going to conclude by relating what I think is a similar market, the 1973-74 bear market. So I started out trading in 72-ish, maybe 71, got into technical analysis. Options didn't even start trading until April of 73. So at the beginning of this, there were no options, but options started somewhere in this area. Anyway, very similar, 1972, market is calm and rising and everything seems great. Market goes to an all-time high in January of 73, just like it did in January of 2022. There's a famous article in Barron's. They interviewed all these panelists and they were all bullish. So the headline on the article was not a bear amongst them. Barron still likes to cite that as a great example of contrary analysis. Anyway, the bear market set in. And so you can see pretty typical bear market with these oversold rallies happening all over the place here, including this pretty big one there. Then the market confounds everybody, goes to a new low in late August, and then has this huge oversold rally. That one pretty much wiped out the bears. That's the kind of one that you just can't really stay short through that. So you get out, and then it's hard to get short again. So about right at that time, the oil embargo started, and the oil embargo drove the market sharply lower in the end of 1973. And so people were able to sort of blame the oil embargo, and then when we started to negotiate with OPEC and the market started to rally, came back up in here, and the oil embargo ended about right in here somewhere, and that was that was really the beginning of the rest of the bear market. It didn't help things at all. We started to fall. At that time, there was the three I's: inflation, interest rate, and impeachment, because Nixon was in trouble with Watergate. Well, we don't have impeachment right now, but we certainly have the other two, and they are just as big a problem now as they were then. And the Fed is as clueless now as it was then. Then it was led by Arthur Burns, who was an academic from Columbia University, who had been on Eisenhower's Council of Economic Advisors, and then got appointed to the chairman of the Fed, I think, by Nixon. Anyway, every time he spoke, the market went down. So then it starts to go down and makes new lows, and then makes more new lows. And then Nixon resigned, and then it really collapsed. And it went all the way down into October. And at that time, I thought it was so ridiculous. Gerald Ford was then president, and he came out with this Whip Inflation Now campaign. And they gave out win buttons. You can still find them on like eBay or something. Well, lo and behold, the market bottomed right then. That's the craziest thing. I mean, inflation was still a problem for 8 more years and what have you, but the market never went any lower. It had a big October reflex rally, came back in December, retested the low, formed a classic W bottom, and just took off, and that was the end of that bear market. Now, this huge bull market that we've been in now didn't really start for a few years later, but that was the end of that bear market. But it's similar enough that I think very common things could happen. We could get this big rally that everybody thinks things are going to be okay, this or that, what have you. But then eventually the bottom falls out. And really, you can see from top to bottom here was about 20, 21 months. I would expect this bear market to last that long. So I'm thinking somewhere late next year, the bear market ends. So if I had to choose where we are now, I'd say about there. In other words, we just had this big oversold rally for 2 months, and just like they did then. And now the market's come back down, and we might be about right here. And people are still hopeful that it's going to find its footing, but it didn't. It went to new low, then had the big rally, and then went to an even lower low, just confusing the heck out of everybody. So, markets are never exactly the same way 2 times in a row, but so far this one's pretty much held in there. And the thing with bear markets is that they have these big oversold rallies, and you basically have to expect them. At least now with options, with put options and even put option spreads, your loss, your risk on a bear market rally. Okay, so that brings us pretty much to the close of the hour. Um, I don't Let's see, are there any questions? I don't even know. Yeah, there are some here. Let's see if I can find some. If you have to leave, fine. Is the presentation recorded? Yes, it is being recorded, and you will be given access to the link for the recording. So I should have mentioned that. Good question. What's the portfolio of a core bearish position? Basically, put bear spreads that we continuously roll down as the market goes lower. That's been our basic core bearish position. You show the buy and sell markers at exact highs and lows. How many bars after the peaks and valleys do you actually say it is a peak? So that's where that computer analysis program comes in. And it's pretty darn good. You usually get it within a day or two after the peak, or sometimes even almost simultaneously with the peak. That computer program will say, okay, that what looks like a little peak there, that really is the peak. What is normal implied volatility range these days? That's hard to say. I mean, the market is the market. So VIX is in the 20s. I'd have to say that's normal, at least for now. Is the unspoken premise that the options crowd, as reflected by put and call volume, is always right? Well, I mean, basically the premise on put and call volume is that the option crowd is wrong. But yeah, I mean, speculators en masse are generally always wrong. So that's what we try to find is mass speculation and go the other way from it. On the question of what is normal implied volatility, a lot of options are usually in the 40s level, while others are in the mid 20s. Is implied volatility greater than 40 considered expensive? Well, what I would encourage you to do, as I said on our website, every Saturday for free, we post a volatility data. So you can see where the implied volatility has been for every stock index or future for the last year. And we also show you the 90th percentile, the 80th percentile, the 10th and 20th. So you can see what's cheap and what's expensive. So just a random number like 20 or 40 doesn't mean anything. You need to look at the statistics of it, and that's where that comes in. And then, of course, if you want, there's a subscription service where you can get that every day, but that's most people just go with the free service once a week. What can we attribute the fact that VIX has not been changing much? A down day, like you say, but did not happen. Well, I think I addressed that with you're talking about lessened demand and excess supply. Again, what's a core bearish position? Do we get a recording? So the core bearish position is a put, the recording, yes. You will get an email telling you where the link is for the recording. Is the put-call ratio good for predicting futures? Yes, it is, but again, only in those extremes. So we have the futures put-call ratio charts, everyone. What do you mean by the Fed not having a clue this time around as well? Well, I just met in 1973, they didn't have a clue either. And they were doing the same things then that they're doing now. And it had just about as much effect then as they did now. So, you know, they got a late start, and now some people are saying they have to catch up, but I still don't even think that does it. It's just inflation is underway, and it will be a problem for the market. Do you have a subscription for daily put call ratios for futures? So if you want a subscription specifically for that, no, but we do have what we call the strategy zone, where you can look at all the put call ratio charts you want to every day. So you could just look at the futures charts if you want to. That's pretty cheap. I think that's $25 a month. Or if you want some more guidance on that, then you would subscribe to the option strategist or the daily strategist, where we look at the charts and pick out ones that we like for trading. Like I said, we are long corn there. We've been long for a few weeks, but we don't have nearly as many futures recommendations as we do, let's say, stock recommendations. Okay, so we're a little bit over our time. I want to thank everyone for attending. And remember, you can always shoot me an email where you see it here on this page. And if you're interested in our money management, this lower website is our money management website. So in that one right there. Anyway, have a great week trading, and hope you make a lot of money. So that will conclude the seminar.